Hey everyone, welcome to another Live with Chaley show. I'm your host, Larry Bailey. As always, we meet on Tuesdays for a meeting that starts around 4:30 p.m. Eastern, 1:30 p.m. Pacific. We will talk about market conditions, loan products, loan programs, scenarios, all kinds of interesting things to try to help you as a real estate investor, or even if you have general mortgage questions, if you're not a real estate investor and you are just looking for a solid place to find educational information, trustworthy advice, and long living cooperation and collaboration with a great lender like Ridge Lending Group. That's why we do these each and every week. So today is May 31st, 2022. And I thought we would start the day off today talking about the markets and what's been happening, because it's on everybody's mind. If it's not on your mind, you've obviously got something else you're thinking of. But today it's all about inflation. It's all about buying power. It's all about what's going on in the world with regards to economics. And what I wanted to kind of go over just to start with is how the day ended with regards to the mortgage market and how that impacts interest rates overall. So as we talked about last week when I did my market wrap on Friday, just before the holiday weekend, we talked about what was coming out this week in terms of new economic information. Now, unbeknownst to most of the regular people like me and maybe you, we might not have actually thought that the European bloc would come out against and support embargoing Russian oil. So, when it comes to world events, as anything else, it will always impact home, always impacts us. Part of the big news about that oil, of course, is what is that going to do to the US economy? How much further more expensive is it going to make oil? How much further more expensive is it going to make gasoline? How much is that going to add to the ongoing inflation issues for the US economy? And then take all of that, right? If that isn't enough, take all of that, add in the Federal Reserve's position to continue to tighten up monetary policy in the US, add into that the European Central Bank's decision that they want to try to continue to tighten up the European interest rates, meaning raising them to try to dampen the consumerism across the globe. And then on top of everything else, we've got home inflationary prices that continue to make things different, right? In some cases, it doesn't really affect affordability. In others, it does. Just depends on who you are and where you are in the country, even in terms of regions. So I wanted to go back to these charts because not that I want you to become a chart watcher, because that's not what you do all day. I'm just doing this stuff because it's all about planning, right? And I want to make sure you have as much information, as does Chaley, as much information at hand so you're educated and you can know what questions to continue to ask, and you can know what questions to continue to demand answers to as best as possible. So on screen, there's a, when we talked about on Friday, we were raising. This was back from May 18th all the way up to May 27th. So a little bit longer than a week, about a week and a half. And then there's this line right here, which is a 50-day moving average. And it basically, the bond prices got beat back down to the level where they are today. This negative 45 is not a good thing. It just means that people have to be careful. Lenders have to be careful about making interest rates better too quickly. If you've been borrowing money longer than a few years, it is always quicker to have interest rates or costs of money increase than decrease. It takes a very long time for bankers to feel okay about cheapening money or lessening the cost of money. And it takes just a blink of an eye to make those costs go up, because you don't want to be on the wrong side of that risk as a banker. All right, you're not in banking to lose money. You're in banking to make money. So we're going to continue to look at this. I issued earlier today a market look back to last week, and we talked about the fact that we had today's information coming out. We're going to talk about that next with regards to home price indexing and the appreciation models across the country. And then also, of course, Thursday and Friday, we've got payroll, ADP, plus non-farm payroll numbers coming out, which again, why do you want to pay attention to that as a real estate investor? Honestly, there's so much going on. You might have a tenant that's late on their rent. You might have a house that needs repair. You might be looking to make some decisions as far as where to invest your money. And a lot of this has to do with where are you looking at for the next 30, 60, 90 days. It's already June 1st tomorrow. So realistically, if you were trying to invest this year, honestly, you've got 3 months to 4 months at most to make that investment happen this year. So think about it. You've got June, July, August, September. That's 4 months. If you go into October, that's 5 months. Now you're putting it yourself with less than 60 days to close. Entirely possible, but if you haven't even found a property yet by October, and now you're trying to find a property and close by the end of the year, that's a tough spot that you might find yourself in. So again, everybody's got something different going on. If you're dealing with a 1031, you have those dates and deadlines to manage. If you're just dealing with personal planning and personal portfolio management, you might have some of that stuff going on. You might also have tax consequences from like maybe you borrowed some money against you're considering borrowing money against the 401k to try to make an investment, rehab a house, and then cash out and get it paid back. Who knows? But we're all in this together. We're here to help, and I want to make sure that again you've got that information. So I want to pull that off screen, and wanted to actually. I need to do a new screen share because Zoom doesn't let me share things. So we're going to go ahead and share this. And so this morning, 8 hours ago, roughly, the position was carefully floating, and the update this morning was in the market end was all about what's the price of oil. Like we talked about, I just went down to my local gas station and saw diesel was over $6 a gallon. I'm in New Jersey. I know I'm probably on the lower average of what's going on in the country. I can't imagine what diesel is costing in California. If I looked it up, it's probably $8. I've got family in Hawaii, and on certain islands, I'm sure it's at least $8, if not getting close to $9. So there's a lot going on. You don't need me to tell you what's going on with oil. You can look that up yourself and figure it out. But here's what I did want to talk about. And so today, the Case-Shiller Home Price Index, which is basically what everybody looks to figure out what did regions of the country look like in appreciation. So I can tell you, like for me, when I'm looking to invest in certain areas, I'll go to Zillow and I'll put a search. If you've never used Zillow to try to find patterns and properties. I'm sure there's others. I just tend to use one and kind of let it go. But what Zillow does for me is it gives a forecast. I don't know honestly how accurate that forecasting is, but I can tell you that one of the areas I look at is Oahu, right? I want to continue to look at investing in Oahu. I was looking at investing in New Jersey, specifically at the Jersey Shore for short-term rental properties. And also then around here, I live in Burlington County, New Jersey, looking for opportunities there too. Maybe it's a smaller home I can fix and flip. So that's what I kind of spend my personal time looking at. And one of the things that stood out for me, again, it was personal, Tampa. I grew up going to Tampa every year. My side of the family's from Tampa, a family that lives there in the outskirts of Tampa. 34.8% year over year in Tampa. I don't understand what's going on there. That frightens me if I'm trying to buy, because I'm worried I'm going to be the fool that buys the last highest property. What I can tell you is that I would certainly, if I was trying to get into Florida, I never would have thought Tampa. Now, Lutz, again, I know this area, right? So Lutz is just outside of Tampa. I don't know if Tampa is hot in a particular area, in a particular neighborhood. So this is, Neely, thanks for the question. What we're looking at right now on screen is the Case-Shiller Home Price Index. So basically, there's a graphic right below this that I'll review. Puts a little bit of this in context. But yeah, this is the rates of appreciation year over year, and it breaks it down into the month. And this information is from March, actually. So so yeah, so it's pretty crazy. So it's March. So let's go down to the graphic, and what this means in this particular case is if the monthly number is 1.7, that annualizes to the numbers we see on screen, because obviously that's times 12. And in some of the top cities, or Seattle for the Seattle, Denver, Colorado, Denver, San Francisco, Tampa, and Phoenix and Miami. So that's the Case-Shiller. Now, if you look at the FHFA, which also has a home price index, the FHFA really focuses on lower priced homes. The Case-Shiller is all homes, but the FHFA only deals with Fannie Freddie, right? So you're going to be looking at single family homes, conforming loan amounts. It's going to really drive in your, let's admit some folks. Eddie, join us. It's going to bring in maybe some of the lower end homes. And in here again, I think this is really important as an investor group to look at where are you looking and when are you looking. So for me, I'm in New Jersey, so I'm considered middle Atlantic. And I've never seen, I don't know where the 15.2 is, but it's not in the areas I'm looking at. In the areas I'm looking at it in New Jersey, it's about 11 to 12, like 10 to 12 is the forecast. That I'm not totally uncomfortable with, but Hawaii, again, like I said a minute ago, Hawaii, I'm looking at 10 to 12 to 14% appreciation year over year. So it's like, at what point do I feel like that's going to stop? I know there's a ton of people getting into the Midwest out here. That's why you see a jump of 2.6 for the month. Same thing with Texas, and then again Florida down here. So, these are some of the regionalized metrics of if you're looking to invest and you're trying to figure out your timing. I bring this up a lot because if today's May 31st and your strategy was to look at certain purchase prices to meet certain rental amounts, and then you're trying to figure out your real rate of return on your investment, and those kinds of answers, you have to make sure you keep that information up to date. That's the point of bringing this information to light to you, because if the last time you were looking at properties was for $100,000 6 months ago, you really need, if you're down in here, you really need to be looking at 110,000 now, because you're 6 months behind the appreciation curve. Now you might disagree with that. You might say, no, I'm going to stick at 100, and that's fine. But keep in mind, you're looking at homes that 6 months ago were priced in the 90s. And that means that the rental for those properties might also be priced as if it were a $90,000 home. So again, I bring this up this information up so that you're staying on top of it in context. A lot of this information we talk about in the mortgage industry to be aware of what's happened, to try to help borrowers prepare or try to help for loan programs qualifying, or even try to help people understand, if they're moving from, I don't know, if they're moving from New Jersey to California, like what are you planning to expect? Or if you're moving from, one region to another, when are you looking to move? And what are you looking to expect? So especially if you're trying to sell a home at the same time. So I'm going to pause just for a second because I've been talking now for 15 minutes. Any questions about what I'm showing on here, or comments, concerns, anything along those lines? If you have any questions, take yourself off mute or chat away. You should be able to do that.
Larry?
Hey, Nancy.
Hi. I've got a question.
Sure.
I noticed that two areas with similar monthly appreciation have different yearly appreciations.
Yeah.
For example, if you look at West South Central, like Texas, 1%. You look at Middle Atlantic, 1%.
Yeah.
But there's a much bigger jump in the yearly. So
Yeah.
Explain that, please.
Previous appreciation numbers. So what you see here is not times 12, right? What you're seeing here is a progression of what the annualized rate has actually been.
Well, then if they don't line up, what you're seeing in something like West South Central is that it was once at 18.6, but now it's growing less steeply.
Maybe, right? I mean, you could be right? It's one month does not paint a picture. And that's a good point, right? So if you're at a 21% annualized and now it's at 2.2, does that mean that this is going to turn into a 28 or 29% annualized? I don't know. We don't know. We have to continue to watch. If this is at 1%, that's annualized 12. Does that mean this is slowing down? Maybe. Same thing for West Central. Maybe. It's hard to get a pinpoint reading on a 12-month picture. And then part of that is, again, always going back and looking. So it's kind of like when I went into earlier today about GDP, and always, and there's always an initial number, and then there's a revision. So information like this, as well as the Case-Shiller up in here. Let's see if I can make this a little bit smoother. So the previous up here for March, previous growth was 1.7 month over month, and then it went to 2.6 month over month in these top cities for all the properties. Does that mean that when you look at the FHFA, a lot of people were the bigger homes, or the homes that were not within the FHFA data set? Again, you're not going to see $1 million purchase here that went from 1.1 million to 1.4 million in California, from one month to the next. You're just not going to see it. So part of the other shadowy parts of this information is these are closings. When did somebody go under contract to buy a house in May, right? Did they go into contract in February or January or March or April or May? This information is from March. So did they go under contract in November, December, January, February, or even March? We don't know. The information is not there. The important part is, I think, is to watch the trending, Nancy. And again, if you're in the mode of trying to buy an investment property this year, just be cognizant of the pace of inflation as you're looking at homes. If you're finding it frustrating that a home purchase price that you're looking for your model, you just can't find property, it might be because you're just looking at the wrong purchase price for the region. I don't know. Does that make sense, Nancy? It's a good question.
Yeah, but it doesn't give me any easy answers, but sure, of course it makes sense.
Well, so the answer is, if it's me, so where are you looking to invest? What region?
Who, me?
Yeah.
Seriously, well, I have been investing in Mid-Atlantic,
Okay.
Pennsylvania more.
Okay. Yeah, Pennsylvania, right?
And what I always want to avoid the hottest places. I know it sounds weird,
Yeah.
but I
You're like me.
look for treasures that aren't so easily noticed and competed for.
Yeah, and that's a lot of work, right? So, I mean, we're looking at the whole country. I mean, there's 300 some odd million people in the country. Who knows how many are moving? Where are they moving to? Where are the jobs?
Right.
If you look at Georgia, there was a big announcement last week about another plant coming in for another car, EV plant. Yeah, these are things that are way beyond my skill sets to
Yeah.
pay attention to. There's just too
Right.
much going on.
Yeah.
But I can absolutely tell you in the places that I focus on, I know what's going on. I know who's doing what. I make sure I stay up on the socials. I make sure I stay up on the government stuff as best as I can. And then most importantly, I make friends with people that know that market. So agents and rehab folks. If I'm really interested and I'm really itching to do something, I'm going to make sure that I combine all of this information along with my feet on the ground, my boots on the ground, the folks that know that area inside and out. Because ultimately, unless it's right next door to me, I have to trust somebody else is going to make sure that my investment is managed properly. Meaning the house and the tenants and the maintenance and all that stuff.
Interesting.
Yeah, it's good points. Good points. But yeah, these are just averages.
Do you think it's a bad approach to look? I mean, I only slightly figure in for inflation because, or what inflation isn't the right word, appreciation.
Yeah.
And really focus on the numbers for immediate cash flow.
Sure.
And inflation, I mean, appreciation is like icing on the cake.
Maybe.
Does
Well,
it
I mean,
make sense
maybe.
for, year by year management? And then when you do the exit, the appreciation is so unpredictable and it's so dependent on other things that I don't know. I've been nervous about including that or depending on that as a factor in investment.
So time's your biggest risk when it comes to an appreciation play, right? So it also depends on the quality of the investment up front compared to the quality of investment at sale. As you know, so as a good example, if you bought a brand new construction in some place in the country, and you went under contract last year, you're probably in a really good spot once you finally take delivery because prices have gone up. So what's your true basis for that? In your mind, you would take your basis for when you went under contract and you decide from there. Some other people would say, listen, when I actually closed on the home, regardless of the purchase price, that's what I want to actually track. So if I went under contract for 100, I'm making numbers up, and actually when I closed, the place was really worth 200. And now when I go to sell it, I sold it at 150. Did I make 50,000 or did I lose 50,000? And you can get into, you can get into ideas about that, but the reality is, how does that impact your overall investment? And most people would say, it's what's the money? What's the money say? The money said, I spent 100, I sold it for 150, I made 50 grand. For me, my feedback for you is appreciation, and Chaley said this too, repeatedly. Appreciation is one component of your investment strategy.
Yeah.
She said herself that, if she can go back, this a few weeks ago, if she can go back in time and talk to her younger self, she would say diversify, but definitely include an appreciation component to your investment portfolio. Doesn't mean that it's the only thing you look at. Cash flow is still cash flow. But the idea is if you can find a smaller property that you might not normally take because the cash flow is like pittance, it's like just covering itself, but you can look at an appreciation play on that, might be worth it.
Excuse me.
God bless. Yeah, I think, yeah, Eddie, I agree with you. There's no downside of looking at cash flow. My problem with My only problem feedback would be if you're buying into a market that has been appreciating consistently and you still what happens if you buy a place and again, I'll use a personal example. In 2006, I sold a house and it was 400. I sold it for 400 and something $1,000, and it was the highest price house in this particular neighborhood. And that house has not gotten back to that value until this year. So if you were the person who bought the home, who paid the price that I convinced you to pay, and then literally 3 months later, the bottom drops out in the 07 recession, and it's taking you another 16 years to get back, or whatever it's been, 18 years to get back, was that a good bet? And the reality is, yeah, for them, because they kept it that long, right? I mean, you keep something long enough, a lot of things considered, it usually will come back. So Nancy, for you and for others, Eddie, especially for you, it's good that the cash flow is there. But I'm always worrying about if I ever need to offload this asset and it ends up owing, being valued at less than what I bought it for.
Yeah.
It could eat into your investment really, really quick. So that's the essence of diversification, right? So you got cash flow, that's great. But if you need to sell the property now, and now you have to take a loss, it could create a reconciliation of all those cash flow gains get wiped out.
But
So
that was a pretty unique scenario.
depends on your strategy. If you've got, if you've got a 5-year buy and hold strategy, maybe it's less impactful for you. It just depends, everybody's got different situations. Our guidance on this as Ridge Lending is to say, listen, you've typically got enough down payment to not worry about having to come out of pocket if you were to sell the house. But that doesn't mean that your investment isn't negative overall.
Yeah.
And I think that's where I was working with somebody last week, and she let me know that there's companies out there that sell these Excel sheets. I still have to click on the link, but there's companies out there that sell these Excel sheets of how to calculate cash on cash return and return on investment. And there's some stuff in there. And one of the things that, I thought about afterwards is there's no spot for reconciliation. And I think one of the things that we do, not as often as we probably should, as real estate investors is to really look back especially when you dispose of a property, or trade or whatever it is that you're doing. But, when that investment is over, what was the real return? What went right with that experience? What went wrong? What did you learn? What did you not figure out? I think those are things that people who have, 10, 20, 30, 40, 50 doors, that they've figured out a pattern that they just rinse, repeat, rinse, repeat, rinse, repeat. And that's not necessarily something you or I could just pick up. We could be in the wrong market. We could be at the wrong time. Maybe we don't have as much assets as they do. So that's why I kind of share this information out, just to kind of, either motivate or to get things moving, or just give the knowledge to say, hey, listen, if you're looking in one of these markets, keep an eye on these numbers, because if you continue to see prices out of your range, maybe it's just something you got to sit back and watch for a bit.
Yeah.
But if you want to get in there, that's fine. Just make sure you understand if it's gone up 2.2% in a month, what is, in next month is 2.2 or 2.3%. Again, this is March. So we're in May now. So if we keep seeing these numbers go up, what happens if we get to a point where all of a sudden now for May's numbers, it's 1 point something, or it's 0 dot something across the country. All that's going to do is reinforce what we think we're seeing in the closings that we've been watching, which is there's a slowdown. This is March's information. If you can remember back to March, I can remember plenty of investors who are getting priced out by cash offers. Like you couldn't find a house because it was just gone before anything else. As of 3 weeks ago, 4 weeks ago, when rates started to pick up, we're seeing stories over the weekend, Memorial Day weekend, where houses are still listed like for a long time, compared to what it was just a few months ago. Could be regional issues, could be property issue. It's just anecdotal information.
Mortgage rate.
Could be.
Yeah.
Could be, right? I think you're going to see, I think it's going to be interesting to see for real estate investors, how many more opportunities there are and how many more sellers are willing to negotiate, because they no longer have streams of buyers trying to win their property.
Yeah, too many have been priced out.
Could be. So later on this week, we're going to see, jobs come out. Why is jobs important? Because, naturally, if people are still employed, they're still spending money. If they pull back on their consumer spending, we'll see if they pull back completely, or if they start to, to look at real estate again as the place to go. We'll see. Eddie, I appreciate the compliment. I'm just an old dog. I've just seen a bunch of stuff, and hopefully this information is helpful. But thank you. I just can't believe Tampa's at 34%. Like, that blows me away. Makes me feel like I should have went back in time and bought a bunch of houses in Tampa. Who knew? Any other questions? Any loan program questions or calculation, like how to figure something out? Anything else I can help with? We saw a lot of folks asking about all-in-one this past week. We saw a lot of folks asking about debt service coverage ratio loans this week. Anything along those lines I can help with? Okay. But as always, if you do, feel free to hit us up on the community or call over to Ridge, 855-74-RIDGE, or email over to info@ridgelendinggroup.com.
Can I ask one more question if I'm not hogging?
You can always, well, you're the only one asking, so go for it.
Well, I don't know. Anyway, what about like suddenly with these higher interest rates, like what about these adjustable rate mortgages, which were sort of dead for a couple of years, and like have they suddenly become a more interesting option for investors in a time like this?
Well, it's interesting, right? So if you haven't, it's called an intermediate locked rate, right? ARMs, adjustable rate mortgage, a true adjustable is either month to month or year to year. If you're doing an interim locked or an interim rate locked adjustable, it's locked for 3 years, 5 years, 7 years, or even 10 years. What the ARMs allow you to do also as a lender, it allows you to add a prepayment penalty in a lot of cases. And it also allows you to give you really high-end margins on top of the index, which allow lenders to make more money when they sell and service that loan. So the idea, though, is that if you take a 3, 5, 7 year ARM, you're right back into how long are we keeping this property? Typically a 3 or a 5 year typically caps at 2% annually. Typically it's a 6% lifetime cap. But you get into these 7, 10 year ARMs, that 7th year, you could have a 6% cap. Same thing with the 10s. You have to check the terms of that. Typically they're 2.26s. Some 3 and 5s are like, they'll go 1.16. And those are, there's all kinds of arms, Nancy. So what do I think about arms? I think anytime fixed rates go a little bit higher, arms come back into a question of, is it something that is worthwhile to me? This gets back into, well, what are you doing with the property?
Yeah.
From an owner occupied perspective, the reason why arms made sense when fixed rates were at 6% or higher is you can get like a 3 or 5 year arm somewhere in the 3s or 4s. And that allow you to lock that interest rate because you knew you were only going to be in this house for this set period of time. Like you deferred the risk to 3 years down the road or 5 years down the road. Someone like me, where if I stayed in a house for 5 years, you were like, what's wrong? Why are you still in that house? So for me to take a 30-year fixed rate loan made no sense. That's typically the conversation. So same thing with an investment. If you can get an ARM, and because you're getting an ARM, you can get an interest only feature and not pay through the nose because it's an investment occupancy, that could be very attractive because you can't get an interest only fixed conforming loan. It's these kinds of things that get into the conversation of what are you trying to accomplish?
Yeah.
So shorter term locked arms or intermediate locked arms, again, 3 5s, 7s. It could be worth your while, Nancy, if you felt very comfortable at interest rate risk down the road, or if that mortgage vehicle gave you the option to get you your lowest monthly required payment by having interest only. Again, you have to watch for prepayment penalties. I know in some arms we have them. They're typically a 3-year prepay. Typically it goes like something like 3-2-1. So the first 12 months is a 3% prepay, second 12 months are 2%, third 12 months are 1, and then after the 36th month, there is no prepayment penalty. That's typically how they work. So as long as you're going to keep the loan for at least 3 years, you keep the property, maybe that long, you know, who cares if it has a prepay?
Right.
Is that what you were thinking?
Yeah. Interesting. Yeah.
Okay. Yeah, it'll be interesting. Again, from our lending perspective, I don't know if it's worth the trade-off. It just depends on your strategy. But again, going right back to that look back, if your history is, regardless of how you talk, if your actions are you're keeping properties less than 5 years, why not do a 5-year arm? Like what would be the downside? The downside is, well, what if I keep it longer than 5 years? And I'd say, okay, well, why is this property different? If this property follows the same pattern of all your other investments, and your average ownership on that or your average time in that loan is less than 36 months, why pay a premium of interest that you're never going to use?
Right.
So good stuff. Thank you, Nancy, as always. Michelle, Neely, and Eddie, you guys are awesome for coming, and I appreciate that. Are you finding?
Thanks for doing it.
Yeah, you're welcome. You're welcome.
Yes,
I see. I'm getting a lot of watches on the market wraps and those weekly updates. So hopefully they're helpful to try to.
Oh yeah,
figure out.
definitely. Thank you.
You can only go so far. Keep talking about loan programs.
Hey, Larry, I got a question for you. Maybe you've answered it elsewhere. But this is this market research. I'm still just trying to get an understanding, a base level understanding. And like you said, it takes a little bit of time to kind of see what those trending markers are and then understand and establish kind of what a trend line looks like, and how that does or doesn't fit within a strategy.
Mhm.
But today you talked about these couple of public reports, which are pretty, lagging indicators, but, very important. Like we're looking at March data, when we're going into June. So obviously these are informative and over time can assist in formulating what that trend line looks like. But are there other reports or metrics that you're looking at on a regular basis, which are more leading indicators or a little bit closer in closing some of that time gap? Or do you have a crystal ball? Do you have a crystal ball, Larry?
So the only thing you're ever going to find that's more close to now
Mhm.
is your actual reports that come out that show closings. So the National Association of Realtors puts out information monthly that
Okay.
gives closings from previous month. I think it comes, I forget when the last one was, but I think it comes out like the second week of the month or something.
Okay.
And that'll give you what happened last month. But again, it's one of those things where what it doesn't, like, I'm always asking, like, what isn't this telling me? Like, what, don't get caught up. It's nice to have the data, but I always worry about, well, what's not, what went into the data?
Mhm.
So my question for you would be, what is it that you're looking for that you're not necessarily comfortable with what you found so far?
Yeah, I think, well, just looking at the data you showed today, so some of those markets that are considered quote unquote hot right now, just trying to, and of course that's the name of the game, right? Like, it just feels a little bit like trying to time the market. I don't want to buy at the peak and sacrifice cash flow on a, from a rental perspective.
Yeah.
But like, also don't want to wait out the game, for a year and a half
Yeah, you'll
until
never get
a
to it.
major bubble
Right.
pops. So that's kind of where I'm headed, is like, if I get a feel for like, is this going to cool down like pretty fast? Was it a steep incline and then a steep decline, or is it better just to kind of like hone in on finding the right deals and, kind of not worry so much about what the macro markets are doing?
I can tell you that if historically, right now, companies are buying properties that make financial sense regardless of their purchase price because they're looking at cash flow.
Mhm.
They don't necessarily, it's like buying stocks. If you're a dividend stock buyer, which I'm not, never have been. But I know folks that diversify their stock portfolio because they buy stocks based upon dividend repayments. And so that's outside of the value of the stock, right? It's just, you're basically paying for the performance of the company in hopes that you get some type of extra dividend based upon how many shares you own. So in terms of real estate investing, if your strategy is, I've got a pile of money, making zero, actually it's losing money in the bank because the interest that I'm getting paid is nothing compared to the appreciation, or excuse me, the inflation that I'm
Inflation,
losing.
yeah. Yep.
So what's the best place? And going back to Nancy and other people too, right? It's like, well, if I could take that chunk of money and I could make it work for me, and it's giving me, a real cash on cash return, cash investment for cash coming back of somewhere in that acceptable range, maybe it's 5 or 7 or higher, God forbid, percent. Should I be worried about, did I just overpay for the property? And the answer is, if you never sell the property, why do you care?
Mm-hmm. Mm-hmm.
Right? So if you buy a stock and the stock is still giving you the dividend that you want for your investment, and the stock is worth pennies versus what you paid for it, do you care? And you have to answer that question, right? And you say, well, it's like anything else. I laugh at my father-in-law, who would constantly tell me how much his house was worth, and I'd say, when are you selling it? He goes, well, I'm not selling it. I said, then why do you care? He goes, well, it's just good to know. It's like, well, okay, I'm glad it makes you feel better, but until you sell it, it doesn't matter. So I think generally speaking, I read an article last week about some chess dude. I don't know if anybody else caught this article, but some chess dude out of Florida. He's got 2 real estate companies. He built an algorithm to basically find properties at a particular algorithm, and he goes out and he buys them. And I'll guarantee none of those algorithms are what's the house worth compared to the market, and did it appreciate too fast? It's what's the value of that house compared to the other houses in the market, and am I able to rent it at a certain amount relative to the cash investment? I think that's still a tried and true pattern. And if Shayla were here, I'd expect her to say the same thing, that if you can buy a house and you look at the cash to carry that house, and look at the rent that you can receive, and look at the cost of maintaining and the risks of that maintenance, and the area that it's in. So if it's in the middle of a place with no jobs, but you still have a tenant, what if that tenant doesn't stay with you? Where are you gonna get the next tenant from? So I don't think any of this appreciation stuff lays into anything other than if you were trying to buy a house with the idea that appreciation was part of the game, that, you know, you're aware of it. I don't think that there's any when we look at our values, are things going to crash? Most folks who are educated on this topic are saying no, because we are still millions of homes underserved.
Right.
So could it soften? Absolutely. Could people no longer afford to pay 500,000 for the house, but now they can afford to pay 450? Yeah, it's a 10% bump, but you know, if that 450 is all the market can support because that's all the people can afford it, you know, if you're not selling, what difference does it make? You know, if you bought it for 500, you put 25% down. So, you know, you go to sell it and it's 10% less than what you bought it for, but you generated cash along however many years you held on to it. Is that a good thing? Depends what your tax consequences were and what your depreciation write-off was. I mean, you know, the whole thing, right? It's all of that into one. And that's kind of my feedback is if you've been a real estate investor and you're looking to make that part of your overall financial goal, you've got to do some self-reflective work to say, here's the last X number, you know, whatever, even if it's one, here's when I bought it, here's what I actually spent, here's what I actually received, and take into everything, here's the decisions I made, here's the things I wish I did different. You should always be doing that, always. If this is part of your second job, right? If this is part of your long-term goal, people literally do this all day long for 8-10 hours, and they build software to try to figure this stuff out. And you or me are just, you know, we're just trying to figure out the average numbers. It's tough, but you've got to pick an area and you've got to focus in and you've got to be serious about if you want to invest. And so that's why that's why we do these things, is because you never know when a question is going to come up or an opportunity. And we want to make sure you get the best information possible.
Yeah.
That
Appreciate
helpful?
it. Yes. Thank you.
You're welcome. You're welcome. And I want to find, again, for those listening along, I'm going to see if we can't do something as Ridge to help with this ROI calculator thing. Because again, I think it's interesting that there's a niche little cottage industry to help support real estate investors to find out the true ROI with like these, apparently they're like Excel sheets, but the formulas are, at least on the one I saw, the formula was broken. It was literally, they had to go manage something. So I want to see what we can do about it to help support the community. I'll let you know. All right, last call. Going once, twice, 3 times. Done. Okay. Thank you, everybody, again. Always a pleasure to be able to answer any questions, and we'll see you next Tuesday.
Thanks so
Have a
much.
great rest of your week.
Thank you.
You too.
Bye-bye.
Bye-bye.
Bye.